Okay, for the second assignment in Unit 3, this is Accounting Transaction Practice, and this is your template. I just want to go through a few of these first ones with you. So what we're going to do is we're going to look at each transaction, and then down here, just like T accounts, we're going to determine the account name and then which account is getting debited and credited, because remember we talked about there's always, with this double entry system, there's always going to be two accounts involved. There will always be one debit and one credit. So we did the first one for you. On January 1st, there was the initial investment of $10,000 into the business, and so that affects our cash account, increases $10, and our owner's equity. He invested $10,000, so each of these is going to increase. With cash being an asset account, it's going to increase on our debit side. With owner's equity being a owner's equity account, it's going to increase on our credit side. Because remember, assets have the increase on the debit, decrease on the credit, and liability and owner's equity both decrease on the debit and increase on the credit. Okay? So let's look at our second transaction up here. On January 7th, we bought equipment for $500. I know you don't know all of the account names yet, but you just kind of go based off of what your transaction tells you. So we're just going to call this account equipment, and looks like we paid $500 cash for it. We know it's cash because if it was on account, it would say purchased on credit or paid for in a future date or something along those lines. Since it doesn't say any of that, we can assume that we're paying cash. So it's the amount of $500, and we need to determine, okay, equipment is an asset account, it's stuff we own. Cash is also an asset account, so they both increase on the debit side and decrease on the credit side. So if we bought equipment for $500, it's going to give me $500 on my debit side. Since we paid cash for that equipment, it's going to decrease my cash account $500. Look at the next transaction. On January 9th, we bought office furniture for $2,000 cash. So we have our account name, office furniture. It says we bought it for $2,000 cash, so we know we're using our cash account. Again, both asset accounts because they're things we own. Office furniture, we put $2,000. Oops, the wrong transaction. We put $2,000 towards office furniture, so that's going to increase on the debit side $2,000, and we paid $2,000 cash, so that's going to decrease on our credit side. Let's look at something that's going to affect our accounts a little differently. So on January 17th, we sold part of our equipment for $200. Okay, so we sold it, and then we got $200 for it. So let's go down here to January 17th. We're selling our equipment, right? You just double check. Sold equipment, yep. So since equipment increases on the debit and decreases on the credit, we're going to put a decrease of $200 here. And then we got it, assuming we got paid cash for it because it doesn't say anything about credit or on account. So then that would increase our cash side. Oops. $200, not cash. Okay, and then let's find okay, let's look at this very next one. Bought computer on credit for $1,000. Okay, so this is saying we bought it on credit. So we're not paying cash, we're paying on account. That's what credit means. And we bought a computer. So we can assume that's like computer equipment. We can just name it computer. Let's see, our amount is bought computer on credit for $1,000. So we have computer, and then we bought on credit. This is going to be account payable. It's going to increase our computer $1,000 because we purchased a $1,000 computer. Going to also increase our accounts payable because we bought this on credit, meaning we're not paying cash right away. We're going to pay for it in the future. So this is going to increase our accounts payable because it's going to increase the amount of money that we owe. So since accounts payable is a liability account, that means we're going to increase on the credit side. So like in all of these transactions, I have a debit, I have a credit. I have a debit, I have a credit. Debit, credit. Debit, credit. Okay, so that can always kind of help you out if you're debiting one side and you're not sure about the accounts payable, whether or not it increases or decreases. Just kind of think to yourself, okay, if I'm debiting my computer equipment, that means this is going to have to be a credit. And since I know I'm not taking away from accounts payable, that must mean credit is my increase side. So that's one way to look at that. So finish up that first section. I threw out part 2 because it was set up incorrectly. And then part 3, we are just naming what types of accounts these are and which sides they increase and decrease on. So the first one's done for you. Cash is an asset account. It increases on the debit side, decreases on the credit side, and then the normal balance is kept on the debit side. Then we have cash in bank. This is also an asset account, and so it's going to have the same increase and decrease sides. I just like to copy and paste so I don't have to type everything. Accounts receivable, also an asset account. It's money we're getting in, and so it's also going to increase and decrease on the same side. Let's look at accounts payable. Okay, that's a liability account, right? Because it's money we owe. And so then that's going to make my increases and decreases switch. So with a liability account, we increase on the credit side and decrease on the debit side. And then the normal balance is usually always kept on the same side as the increase side. And then you guys can do owner's capital. Okay, with this part 4, we're looking at the transactions and determining what's going on. So with number 1, I want to find number 1 here and then match it. Okay, here's the other number 1 here. So if my cash is increasing by $50,000 and my owner's capital is increasing by $50,000, what does that tell me? Well, I'm going to put that together and say that Mr. Williams has invested $50,000 into his new business, because I know that those types of transactions usually mean that we're just starting the business and we're making that initial investment. So then I look for my number 2 transaction, which is right here and under office equipment. So if my credit is decreasing $10,000 and my office equipment is increasing $10,000, that tells me that I'm probably purchasing office equipment for $10,000 cash. So I'm going to go down here and I'm going to say, Mr. Williams purchased office equipment for $2,000. And then I'll go up here and look for my number 3 transaction. So I have accounts payable is increasing by $5,000. I have office equipment increasing by $5,000. So I'm going to assume that I bought some office equipment because it's increasing. And this time, since my cash is not decreasing and my accounts payable is increasing, I'm going to assume that I bought it on account. So down here on my 3rd transaction, I'm going to say Mr. Williams purchased office equipment on account for, and it was $5,000. Okay, so now let's do one more. I'm looking at my accounts receivable is increasing, and my other number 4 is over here. Office equipment is decreasing. So if my office equipment is decreasing, that means I probably sold some of it, especially if it's going on my accounts receivable, which means a customer is purchasing this equipment from me, or Mr. Williams in this case, on account. So instead of when we make a purchase, it goes to accounts payable because it's what we will be paying. When a customer makes a purchase on account from us, that's money we're going to be receiving. So it goes onto our accounts receivable. So I'm going to say Mr. Williams sold office equipment for, was it $200 or $2,000? $2,000 for $2,000 on account. Okay, we'll finish up the rest of those transactions. You're matching them up and just determining what took place for those transactions to occur.